Bitcoin has been searching to kind of break out at, say, the 30,000 level, and it's not there yet, even though it's up today. How is the macroeconomic backdrop, whether we're talking about inflation or where interest rates stand, affecting Bitcoin, Ethereum, and the broader crypto market?
When you're looking at things right now, you think stocks are poised to break out to the upside?
The traditional academic stuff isn't working for the bears, and the traditional academic stuff is actually against the bulls, but the market remains, quote unquote, resilient. Add all of that up, and I think the market can, will, and should likely be soft heading into summer.
We start the show with AI, and everything sort of revolves around AI. And the move in these stocks has led to a pretty good move in the NASDAQ 100. Right. Toppy?
What does the future hold for the crypto market in 2023? Will we see continued growth, or is a correction on the horizon? Can inflationary pressures be tamed? In today's video, Raoul Pal shares his viewpoint on the market outlook for 2023. To know more details, stay tuned until the end of the video. And if you want to stay up to date with the latest crypto insights, markets, and the economy, be sure to hit that subscribe button and the bell icon. Okay, are you ready? Let's dig into it.
I think inflation headline CPI gets to zero or even negative by the summer. It then picks up again. And what we will then see is the slow effects of owners equivalent rents, services inflation, which is mainly owners equivalent rents, and wages. That usually lags on for 18 months. So that keeps inflation low coming out of a recession. And I think the AI thing, as I've talked about, is a deflationary nuclear bomb in all of this. So I think the probability is that unemployment is sticky coming out of this, stickier than expected, and inflation is not as rampant. So even if commodity prices, and I understand there's some tightness in commodity markets, but everybody's tried to take that trade has been taken out and shot right now by the markets. And Dwight Anderson warned us about this on Real Vision. He's like, yeah, they're tight, but there's no demand. And if you keep looking at the supply side of the equation, you'll get carried out because the demand equation will kill it. He said, the next time we come into the upside of the business cycle, we are going to get some commodity inflation, but that can be easily offset by deflation of AI, much like we saw in the mid 2000s with China coming in. They caused a massive spike in commodity prices, but inflation was relatively sanguine because of the effect of China in the WTO meant that goods were coming out cheaper, globalization. This side, we've got AI, which is hugely disruptive, balancing against the commodity inflation that can come. So I think inflation is slower than the market expects.
Headline CPI inflation, according to Raoul Pal, is poised to hit zero or even turn negative by the summer, only to pick up again later on. But here's the twist. The effects of owners' equivalent rents and services inflation, particularly in the form of wages, usually lag for about 18 months. It's like they're playing catch-up. And that's not all. Raoul Pal drops a bombshell by describing the impact of AI on inflation as a deflationary nuclear bomb. Mind-blowing, right? Amidst this intriguing narrative, Raoul Pal believes that there's a high probability that unemployment will stubbornly remain high while inflation remains in check. It's like a balancing act, my friends. In a nutshell, inflation might not be as rampant as the market expects. With AI and global dynamics at play, inflationary pressures might just be tamed. It's like a thrilling mystery waiting to be unraveled.
We can look at this, which is the chart of speculative positioning. Let me change that one and change to this one now. This is speculative positioning in the S&P 500. I have literally never seen anything like it. So the market is insanely bearish, which is why the Nasdaq's up 1.8% today, because people just don't want to believe it. They're angry. They want the market to go down. They want their bear market and they want their justice, and it's not happening. And the reason being is everybody's ridiculously, ludicrously short. On the flip side of the equation, we're going into this, and that's obviously driven by the debt ceiling. The other side of the debt ceiling is this chart, which is the speculative positioning in bonds. Now, bonds, as I mentioned before, have not been playing ball. I thought yields should be falling, but they haven't yet. But look what's going on here. This is the largest speculative short positioning in the history of the bond market. So if anything changes at the margin here, we're going to see a gigantic rally in bonds, which I'm still expecting, but this whole debt ceiling dynamic is getting in the way. Inflation dynamics on the other hand are falling very fast. Things like the Truflation index, which is a real-time calculation on chain of millions of prices, suggests that US CPI as of today is 3.2%. I think it still goes to zero by June or July, which Alex Gurevich has been talking about both on Real Vision and also on Twitter as well. We're very in a small camp of that. We're also seeing wage growth coming down. We're seeing rents and wages are the most lagging of all. So they're all still to come down. So generally speaking, economy slowing. We've got this whole debt ceiling stuff that's getting people very nervous. The resolution of that, one way or the other, ends up being ongoing liquidity as the economy slows. The banking issues have slowed down for the time being, but doesn't mean it's gone away. These things tend to come in phases. And so technology and crypto tend to outperform. Crypto's been consolidating for a while, but it's still up 50-60% on the year, still the best performing asset. But again, it's likely to pick up as liquidity comes forward, as shown by our forward-looking liquidity indicators. And we've probably got 20 or 30 different things we could show you to say that liquidity is going up. So I remain massively bullish. There will be a correction at some point in all of this. As people start throwing in the towel on the short positions, then we might get a correction before we continue to move higher later on in the summer. So overall, super bullish. The only one that's puzzling me is the bond market still hasn't played ball, but I think we need to get through this debt ceiling thing, and then a lot of hedges get unwound.
The market sentiment is off the charts. Bearish, angry, and longing for a downturn, seeking justice. But guess what? The market is playing hard to get, with the Nasdaq soaring 1.8% today. The reason? Overwhelming short positions taken by investors. As the economy slows and concerns about the debt ceiling linger, liquidity becomes the key player. While crypto may be taking a breather, it's still up a whopping 50 to 60% this year, making it the reigning champion of the asset class competition. And here's the exciting part. Liquidity is on the rise, according to our trusty forward-looking indicators. I'm riding the bullish wave, my friends. Sure, there might be corrections along the way as short positions unwind, but the overall trend remains upwards. And who knows, we might even have a summer correction to spice things up. Let's get into the next clip to hear more from Raoul Pal. But before jumping ahead, be sure to give a big thumbs up to this video.
And we saw this in 2011. The S&P fell 20%. Now, what it did was correct 76% of the rally that it had. Could we see a similar move here as the shenanigans around the debt ceiling mean that the TGA gets rebuilt? Yes, which is why I said, listen, there's got to be a correction here at some point, but it may be from higher than here because the market's in this short squeeze because everybody's hedged for this thing. And so it just squeezes everybody up. And then, yes, I think that there's a very decent likelihood of that. And in fact, I put out a trade recommendation for Pro Macro around the ideas of this, which is that, listen, there's a risk of this causing a sharp pullback, but the outcome will be more liquidity. So there's actually two ways of playing this in the end. So yes, I think it's a potential issue, and I think there is a potential correction, but probably not yet.
Back in 2011, the S&P took a nosedive, plummeting by a staggering 20%. And guess what? That correction accounted for a jaw-dropping 76% of the previous rally. Talk about a wild ride. But here's the burning question. Could history repeat itself amidst the current complications surrounding the debt ceiling? Raoul Pal has emphasized the likelihood of a correction, but here's the twist. It might happen from a higher market level. Right now, we're caught in the grip of a short squeeze frenzy as everyone eagerly anticipates this event. Prices are shooting through the roof, but danger is lurking in the shadows. So, while Raoul Pal firmly believes that there's a potential issue on the horizon and the likelihood of a correction, let's not jump the gun. It might not happen in the blink of an eye. We're in for a bumpy ride, but we'll navigate through it. Do you agree with Raoul Pal's viewpoint? What lies ahead in the world of crypto? Will the markets continue their upwards trajectory or face a turbulent storm? What factors are going to shape the global economy? Let me know your thoughts in the comment section below. And of course, don't forget to subscribe to my channel for more updates on crypto and the economy. Also, be sure to give a big thumbs up to this video. Thanks for watching, and we'll see you next time. Adios.